Hi guys, I'm Lewis,
And I'm John.
and we're with American Homeland Title. Today we're going to talk about how to compare two loans to determine which loan is best for your current situation. So John, when comparing loans, what other factors should I consider?
Cost and time are two factors that need to be considered. When looking at cost, obviously, if one loan is at 4% with very little cost and another loan at 3.5% with a lot of cost, it's hard to determine which loan is better without considering the time factor.
So what do you mean by time factor?
Well, what I mean by time factor is what is the expectation of the borrower to recoup those additional costs. For example, if one loan is going to be $3,000 more expensive, but it saves $50 a month, the calculation is going to be how many months does it take to recover that cost. So at $3,000, a $50 a month savings, it would take 60 months to recover that cost. So if the borrower had an expectation of being in the home, or at least in that particular loan, for at least 5 years or 60 months, then it would be a break even. If they're going to be there less than 5 years, they probably should take the 4% rate instead of the 3.5% rate. However, if they were going to be there expectation-wise over 5 years, then they would want to probably take the lower rate with the additional cost. It all comes down to which is a better deal for the consumer.
So John, what if I'm thinking about refinancing my loan? Is now the time for me to refinance?
Well, it's going to be the exact same calculation as we did before when comparing two loans. First, you're going to take a look at the current rate on your current loan. Then you're going to look at the rate on the potential new loan that you can do. You're going to want to figure out what the monthly interest rate savings is going to be, and then factor in the cost and do the same calculation as we did before. So if you're going to be able to save $100 a month, but it costs $2,000 to do the refinance, then the calculation is going to be 20 months. If you expect to be in the home or at least in that loan for at least 20 months, then it probably makes sense to refinance. However, if you think you're going to be getting out of the loan in the next year, probably does not make sense to refinance.
John, that's great information. What other factors should I be considering?
Well, the one thing that you should always consider is that on any loan, you're always paying interest on the outstanding principal. So the quicker you can pay down principal, the less interest you'll pay over the course of the loan. Another factor to consider is that the shorter the term on the loan, the less interest you'll pay over the course of the loan. Anytime you have an opportunity to pay extra principal on a loan, that'll reduce the total amount of payments you're going to make over the life of the loan. So typically with a shorter term loan, the rate's going to be less. Rate is a factor of risk. The longer the bank has to extend money, there's a bigger risk that the consumer might default on that particular loan. So typically a 15-year loan is going to have a lower rate than a 30-year loan, and a 10-year rate is going to have a lower rate than a 15-year loan.
So John, I only have 20 years left on my loan, and I really don't want to take out another loan for 30 years. What are my options?
Well, that's a good question. A lot of people say, well, the rates are lower, but I'm already 8 years, 10 years into my loan, and I don't want to go into debt for another 30 years. Here's a little known fact, but every lender has the ability to customize a loan for you. So if you want a 22-year loan, the lender can give you a 22-year loan. Here's what you need to factor in when you're considering a 22-year loan. Loans are typically done in tiers. So there is a rate for a 30-year rate. Some lenders will have a 20-year rate. Some lenders will have a 15-year rate, and some lenders will have a 10-year rate. So if you wanted to say 20 years left on your loan, and let's say the lender had a 30-year tier, a 15-year tier, and a 10-year tier, you would have to take the 30-year rate, but they could amortize it over your 20 years or 22 years or whatever term you have left. Now, let's say that you only had 13 years left on your loan. Well, then you could jump into that 15-year term, but then they could amortize it over 13. So what happens is, based on these different tiers of loans, you're going to have different interest rates. However, within those tiers, you can set any amortization rate you want. And here's the key thing. The shorter the term, the less interest you're going to pay over the life of the loan, and you're going to save money. Even though lenders don't advertise it, any loan can be customized to your particular term specifications. Another point to consider, whenever you're making a mortgage loan payment, you're always paying last month's interest. And you're always paying interest on the outstanding principal. So the quicker you can pay down principal, the less interest you're going to pay over the life of the loan. One last point to make, if you have the ability to make biweekly payments, that'll also save you money on the interest you'll pay over the term of the loan.
So guys, that about does it on the factors that you should be considering when comparing two different loans. You can always give us a call at American Homeland Title or visit us on the web at AmericanHomelandTitle.com.
Thanks for watching.